Welcome to Griffonomics.
Glad to be here.
Today we have a really fascinating deep dive for you. What if I told you that a retail giant could grow its store footprint, post higher top-line revenue, and yet still be quietly shrinking from the inside out?
Yeah, it's a classic case of optical illusions versus structural realities.
Right, like on the surface, it looks like a machine running at full speed. But if you look closer, the foundation beneath all those gleaming new stores is actually shifting.
Oh, absolutely. When a business model collides with a frozen macroeconomic environment, the numbers you see on a headline rarely tell the whole story.
And getting to that whole story is exactly our mission today. We've gone through a massive stack of sources for this deep dive. We're looking at granular strategic reports, analyst notes, raw earnings call transcripts, and it is all centered on Floor Decor.
Or FND, as you'll see it on the ticker.
Right. And specifically, we are tackling their housing lock-in inflection analysis. We really want to explore this fundamental friction, like how does a company maintain a high-growth compounder narrative for investors when it is completely tethered to a historically low housing turnover environment?
Which is really the defining economic reality of the moment. We have to separate the signal from the noise here.
For sure.
Because honestly, the optical illusions on their balance sheet right now are incredibly persuasive.
Exactly. So whether you are a seasoned investor who maybe holds this stock in your retirement portfolio, or you're just trying to understand the actual mechanics of the current housing freeze, this analysis is going to reveal the hidden financial realities behind those shiny retail numbers.
And we're going to get into the radical unit economic transformation they're attempting to.
Yes, the unit economics, the pro-loyalty 2.0 pricing pivot, and of course that free cash flow conversion bridge. And to help us do that, I've got our analytical guide right here to walk us through all these strategic pivots.
There is definitely a lot to unpack beneath the surface of those new store ribbon cuttings.
So to understand the financial pressure Floor and Decor is facing right now, I think we first have to understand the massive scale of their moat.
Right, because that scale is exactly what is currently masking the decline in organic demand.
Exactly. I mean, we are talking about absolute specialty dominance here. They operate 270 warehouse format stores. And for you listening, these are not your typical strip mall retail footprints.
No, not at all.
These are enormous. They average 76,000 square feet. That is literally larger than a professional football field.
And the physical footprint is really just the beginning of the story. The real moat is what they actually put inside those 76,000 square feet.
The inventory.
Right. They are stocking roughly 4,200 unique SKUs in stock, ready to go. And that scale is their primary weapon against the big box generalists. Like if you go to a massive general home improvement store, they might only dedicate, what, a couple of aisles to flooring?
Yeah, maybe 2 or 3 aisles max.
Exactly. They're offering maybe 15 to 20% of the stake-you depth that Floor & Decor has.
So if I want a very specific, I don't know, gray wide plank oak laminate, the big box store might have 3 options and probably only enough boxes in stock to do a half bathroom.
Precisely. Whereas Floor & Decor offers what the industry calls job lot quantities.
Job lot quantities.
Yeah, meaning you can walk in, find exactly the niche style you want for an entire 3,000 square foot house, load it onto a forklift, and drive off with it that exact same day.
Wow. So no waiting 3 weeks for a special order.
Right. And their revenue infrastructure perfectly reflects that depth too. If you look at the sales mix, 25% comes from laminate and vinyl.
Okay.
Then 23% is from tile, and another really crucial 20% comes from installation materials and tools.
Right, the thin set, the grout, all that stuff. And what's really interesting to me in the sources is their customer base. It's a perfectly balanced 50-50 split.
Yeah, the segment split is fascinating.
You've got your DIY or buy-it-yourself homeowners on one side, and then your professional contractors on the other. Exactly 50-50.
And that split is vital. Because the professional contractor, the pro, they provide behavioral stickiness.
What do you mean by stickiness?
Well, think about it. Homeowners might renovate a kitchen once every 10 years, right?
If that.
Exactly. But a pro is doing a kitchen every 3 weeks. They need reliability, they need those job lot quantities available immediately, and they drive repeat high-ticket purchases.
I see.
It is a fantastic compounding business model. Assuming, of course, that housing is actively turning over.
Right. And, okay, let's unpack this. Because when we look at the fiscal year 2025 financial reality check from their earnings reports, on paper, it looked pretty good.
Oh, it looked great on paper.
Yeah. They reported 5.1% total sales growth, hitting $4.68 billion. If you just read the headline of the press release, you'd think the engine is humming perfectly.
And that right there brings us to what analysts are calling the growth illusion.
The growth illusion.
Yeah. Because that entire 5.1% top-line growth, it was driven solely by the fact that they opened 20 brand new warehouse stores.
Oh, wow.
If you look at the stores that were already open, the underlying organic demand is actually shrinking.
So this is the same store sales metric.
Exactly. Full-year comparable store sales, or comps, it measures sales at existing locations open for more than a year. And those actually declined by negative 1.8%.
Negative 1.8.
Yeah, and the momentum's going the wrong way, too, because it dropped even further to negative 4.8% in the fourth quarter.
So it's basically like adding more and more cars to a freight train just so you can claim the train is getting heavier, while the actual engine pulling the whole thing is rapidly losing steam.
That is a perfect analogy.
Aren't they essentially just buying top-line growth by taking on massive, heavy fixed costs? I mean, you build a 76,000 square foot building, you have to pour the concrete, pay the lease, staff it, air condition it, and stock it with millions of dollars of inventory.
You've hit on the exact dynamic. Expanding the store fleet while same-store comps remain negative actively degrades their operating margins.
Because the costs are just eating them alive.
Right. Those new rent bills, the labor costs, the supply chain logistics, they're dramatically outpacing the actual sales productivity of the buildings.
And doesn't management kind of admit this?
Basically, yes. If you look closely at management's own guidance for fiscal 2026, they essentially admit to this stall. They are projecting earnings per share of $1.98 to $2.18. But that includes a financial quirk we call the 53rd week optical lift.
All right, so for you listening, retail accounting often uses a 52-week calendar that occasionally requires a 53rd week just to realign with the actual calendar year.
Yeah, so it's literally just an extra week of pure operating sales thrown into the fiscal year.
Which skews the numbers.
Completely. That extra week artificially boosts their earnings per share by about 8 cents. And if you strip that artificial 8 cents out of the projection, their underlying organic earnings growth has essentially flatlined compared to 2025.
Wow. Okay, so if the engine is losing steam, we need to look at the macroeconomic terrain that's actually causing this slowdown, because that terrain directly explains why the company's cash position is deteriorating.
And that means we have to talk about the housing market.
The housing market.
Yeah, if we connect this to the bigger picture, Floor Decor is effectively making a massive macroeconomic bet on people moving.
Right.
Approximately 35% of their revenue is tied directly to what we call transaction-triggered remodeling.
Meaning, I buy a house, I remodel it.
Exactly. When someone buys a new home, before they move their furniture in, they usually rip out the ugly carpets and put in new floors. Therefore, their fundamental success is highly sensitive to the rate of housing turnover.
But right now, we have the infamous lock-in effect.
The golden handcuffs.
Yeah. For you listening, you probably know this intuitively. With 30-year mortgage rates stuck stubbornly between 6.5 and 7.0%, homeowners absolutely refuse to give up those 2 or 3% pandemic-era mortgage rates they locked in a few years ago.
Nobody wants to move.
I mean, you aren't going to sell your starter house and double your interest rate to buy a slightly bigger house unless a major life event forces you to.
And the macro data absolutely reflects that paralysis.
Right.
This lock-in effect has driven annualized existing home sales down to a historic low of 3.91 million.
3.91 million.
Yeah, people are staying put. And because they aren't transacting, that transaction-triggered remodeling demand, that 35% of Floor & Decor's revenue, is severely depressed.
And here's where it gets really interesting, because that macroeconomic freeze doesn't just hurt top-line sales. It completely changes the cash profile of the business behind the scenes.
Oh, dramatically.
Like, the most alarming metric for investors reading this report right now isn't just the negative comps, it is the free cash flow collapse.
Yeah, the FCF collapse is brutal.
I mean, we are looking at a staggering 75% drop over just 2 years. Free cash flow plummeted from $256 million in 2023 down to just $64 million in 2025.
That's a huge cliff.
But wait, if top-line revenue actually grew 5.1%, how does free cash flow drop 75%? That math doesn't make sense on the surface. Like, where did the cash physically go?
Right. It is a breathtaking drop. And it requires us to look at the mechanisms of corporate accounting. The primary culprit for that $190 million collapse is a massive working capital headwind.
Okay.
Specifically, the normalization of trade accounts payable.
Okay. Pretend I'm 5 years old. Explain normalization of trade accounts payable.
Sure. Think of it like running up a bar tab.
Okay, I like that.
During the massive pandemic housing boom, Floor & Decor had immense leverage. They negotiated extended payment terms with their suppliers. They essentially told the companies making their tile, hey, we're going to buy millions of dollars of your product, but we aren't going to pay you for 90 or 120 days.
Wow, okay.
And that allowed Floor & Decor to sell the tile to a customer, collect the cash, and just hold on to it for months before ever paying the supplier. It's effectively an interest-free loan that bloats your cash on hand.
Ah, I see. But eventually, the boom ends, the leverage shifts back, and the bartender says, look, I need you to close out this tab tonight, and from now on, you pay for your drinks as you order them.
Exactly. The payment terms normalize back to standard 30-day cycles. And when that happens, all that cash you were holding on to suddenly drains out of the business to settle the accounts. It was a temporary cash benefit that is now fully unwinding.
That makes so much sense. But I want to push you to look even deeper under the hood of that remaining $64 million figure.
Okay.
Because $64 million is still positive cash generation, sure. But what is the actual impact of stock-based compensation here?
Oh, the SBC impact.
Yeah, because that's a non-cash expense that often makes profitability look way better than it really is for the everyday retail shareholder.
That is a critical adjustment to make.
Yeah.
Companies often pay their executives and employees partly in stock rather than cash, right? It saves the company cash in the short term, but it dilutes the value of the shares you hold in your portfolio. So when you take that reported $64 million in free cash flow and you strip out the $29.5 million in stock-based compensation.
Which is very real dilution.
Exactly. Very real dilution to the investor. The true cash generated for shareholders in 2025 was a meager $35 million.
Wow. $35 million.
Yeah. For a company valued in the billions, that cash conversion is incredibly, incredibly thin.
So let's put ourselves in the shoes of the CEO here. You are facing negative comps, your DIY customers are completely frozen by mortgage rates, and your free cash flow has basically collapsed.
It's a tough spot.
You have to pivot to the only people who are still reliably buying flooring, which are the pros. And this brings us to the strategic inflection point and really the most vulnerable part of Floor & Decor's 50-50 customer split.
Right, Brad Paulsen's strategy.
Yeah, Brad Paulsen just took over as CEO at the start of 2026, and on his debut earnings call, he offered a very rare, almost uncomfortable moment of executive candor regarding their pricing model.
He really did. You see, Floor & Decor has built its entire empire on an everyday low price model, or EDLP.
Right.
The philosophy is total transparency. The price on the shelf is the best price, it's consistent, and it's great for the DIY homeowner who just wants a fair deal without having to haggle.
Sure.
But Paulsen openly admitted that this EDLP model puts them at a severe structural disadvantage against independent mom-and-pop dealers when it comes to winning over the pro customer.
And let's explain the mechanics of why that is, because it's super interesting. If I'm a professional contractor and I go to an independent dealer to buy tile for a client's kitchen remodel, the price tag on the shelf might say $10 a square foot.
Right.
So I write up my invoice and I charge my client $10 a square foot for the materials. But the independent dealer secretly gives me a $2 per square foot volume rebate on the back end because I buy from them all the time.
The rebate gap.
Yes, that $2 gap, that is my profit margin. I rely on that hidden rebate to keep my contracting business afloat and feed my family. But Floor & Decor's flat, transparent pricing doesn't offer that hidden margin. The price is just the price.
And what's fascinating here is that management is finally acknowledging that radical transparency isn't always what a business-to-business customer wants.
They need the secret margin.
They absolutely do. The pros actively need that rebate gap to pad their own margins without looking like they're upcharging the homeowner. And because of this realization, Floor & Decor is actively designing a massive strategic pivot called Pro Loyalty 2.0.
Pro Loyalty 2.0.
Yes. They want to completely overhaul their pricing architecture to finally compete with independent dealers and close this rebate gap.
But looking at the strategic roadmap and the sources, the timeline is the real risk for anyone holding a stock right now. I mean, they are spending all of 2026 just to evaluate, design, and test this new pricing architecture.
It's not a quick fix.
They don't even aim to launch Pro Loyalty 2.0 nationally until early 2027.
Which means the company faces 2 full years of investment, pilot testing, and potential margin compression before seeing a single dollar of financial benefit from overhauling their most crucial customer segment.
2 years is a long time in retail.
It's an eternity. And it's a delicate surgery, too. They have to redesign their commercial pricing system to give pros a discount, without accidentally crushing their own gross margins across the board.
And while they wait for this pro strategy to eventually pay off in 2027, they have to aggressively cut costs and protect their margins today.
Exactly.
But the solutions they are implementing introduce entirely new execution risks. We mentioned it a little bit earlier, but let's dive deep into the operating leverage trap.
Oh, this is a big one.
When you are building massive 76,000 square foot stores and your same store sales are shrinking, the fixed costs of those new buildings act like a lead anchor. You have empty aisles that still need to be lit, air-conditioned, and staffed.
Right, and this raises an important question. How do you keep expanding your store count, which Wall Street demands, by the way, without destroying your profitability?
Right.
Brad Paulsen's major initiative here is a radical step change reduction in new store capital expenditures. Just to give you the numbers, back in 2023, it cost Floor Decor about $11.4 million to build and open a single new store.
$11.4 million.
Yeah. Paulsen is targeting a massive drop, down between $7 million and $8 million for the 2026 class of stores.
But wait, that is a massive haircut to construction costs. How do you shave $3 to $4 million off a store build? Like, you can't just ask the electricians to work for half price.
No, you definitely can't. You do it by abandoning the build-from-scratch model.
Oh, okay.
Instead, you utilize slightly smaller formats in certain markets, and more importantly, you aggressively target second-use facilities.
Second-use facilities.
Yeah, instead of buying raw dirt and pouring a new foundation, you find an abandoned big-box retail shell, like an old Toys R Us, a defunct Bed Bath & Beyond, or maybe an empty grocery store, and you retrofit it.
But retrofitting comes with its own mechanical headaches, right? I mean, think about it. A Toys R Us was built to hold shelves of stuffed animals and board games.
Right.
Floor Decor is dealing with millions of pounds of literal stone and ceramic tile. You can't just put 3,000 pallets of travertine on a floor not designed for it. The concrete foundation will literally crack.
Exactly. The structural engineering challenge is immense. You have to reinforce the concrete slabs to handle industrial forklifts and these immense static loads. You have to rip out the commercial HVAC and install warehouse-grade ventilation.
It's a huge project.
It is. However, if they can successfully engineer this and hit that $7 to $8 million target, it fundamentally changes their unit economics. Their cash-on-cash return for a new store would jump from roughly 13% up to 27%.
Wow.
It's a brilliant pivot if they can execute it safely.
Okay, so another area where they have aggressively reshaped their business is in the global supply chain. And looking at the reports, I really have to praise a major win here, which is their China de-risking.
Yeah, they've done a lot of work there.
Back in 2018, 50% of Floor & Decor's receipts were sourced directly from China. But through a massive multi-year effort, they reduced that exposure down to just 3% by the end of 2025.
50 down to 3.
Yeah. For any investor worried about geopolitical tension, that is a massive achievement in supply chain sovereignty.
It is a durable structural achievement for sure. And it directly helped them push their gross margins up to an impressive 43.6%. However, it requires a serious counterweight in our analysis.
Okay, what's the catch?
Because they didn't just magically bring all that heavy manufacturing back to the United States, they just moved the vulnerability.
Ah.
They heavily concentrated their new supply chain in Southeast Asia. Today, a staggering 97% of their current receipts are coming from places like Vietnam, Cambodia, and India.
So basically, out of the frying pan into the fire, depending on which way the global trade winds are blowing. I mean, we aren't punishing them for leaving China, but we have to recognize the new target on their back.
Precisely. That concentration means they are now highly vulnerable to broad tariff expansion on Southeast Asian imports. Management has already explicitly warned analysts that these new tariff costs will build up in their inventory accounting and begin pressuring gross margins in the second half of 2026.
Ouch.
Yeah, they're forming steering committees to try and mitigate it, but it remains a significant looming threat to their profitability.
And on top of macroeconomic tariffs, there is an internal self-inflicted operational risk we absolutely need to flag for you. Floor & Decor is currently in the middle of a multi-year shift to a new enterprise resource planning system, a new ERP.
Yes, the ERP implementation.
For those unfamiliar, an ERP is essentially the digital nervous system of the company. It's the software that tracks everything from payroll to the exact location of a single pallet of marble across 270 stores.
Right.
And they are just ripping out their core financial and merchandising digital infrastructure and replacing it.
And what's deeply concerning about this is that management has provided no disclosed cost or definitive timeline for this implementation.
None.
None. And large-scale ERP implementations at multi-hundred store retailers have a notoriously catastrophic track record.
Really? Why is it so dangerous?
Because if the system misfires, the business stops functioning. We've seen major retailers undergo ERP shifts where the new system literally just loses track of inventory.
Oh, no.
Yeah, imagine a pro customer shows up to pick up 50 boxes of tile. The system says it's in the back, but the physical shelf is empty. Or worse, the point-of-sale systems at the registers just go dark.
That's a nightmare.
It is a classic source of execution risk. It's highly prone to massive cost overruns and severe inventory disruptions. It's like performing open-heart surgery on a patient while they are running a marathon.
Man. So what does this all mean for the listener's portfolio? If I'm summarizing all of this, we have a company dealing with negative organic growth, a collapsed free cash flow profile masked by accounting terms, a 2-year waiting period for a new pro-pricing strategy, looming tariff threats, and a mystery open-heart surgery ERP implementation.
It sounds bleak when you list it all out like that.
It sounds terrifying. Yet, looking at the analyst notes in the sources, the strategic outlook remains compelling for a certain type of investor.
It really does. The final verdict from the granular analysis is that Floor Decor is rated as a BUY. Specifically, they are categorized as an asymmetric recovery play.
Okay, explain that.
Right now, because of all the fears you just listed, the stock is trading at a valuation of roughly 10 times EBITDA.
And EBITDA, just to clarify for you listening, is earnings before interest, taxes, depreciation, and amortization. It's essentially a proxy for the core cash-generating power of the company's operations.
Exactly. And a 10 times multiple on that core cash generation is well below their historical norms from when the housing market was functioning properly. Wall Street has basically priced in the winter.
They know it's bad right now.
Right. And this creates a high-conviction entry point for investors who are willing to wait for an inevitable housing recovery.
Because the demand isn't gone, it is simply delayed. We have to look at the structural floor supporting this company's long-term thesis. The U.S. housing stock is aging rapidly. The median age of a home in the U.S. is now over 40 years old.
Over 40 years.
Yeah. You cannot put off replacing a rotting subfloor, a cracked kitchen tile, or a leaking shower pan forever. Even if mortgage rates stay high, eventually things break. There is a massive, multi-year remodeling backlog building up like water behind this mortgage lock-in dam.
Exactly. And while they wait for that dam to break, Floor Decor still has no direct national competitor that matches their warehouse format and scale.
Sure.
They have successfully defended their gross margins above 43%, and despite the cash flow drop, they still have the liquidity to survive the winter. The investment bet here is simply on the thaw.
Which leaves us with a final provocative thought to ponder. We've talked a lot today about Floor & Decor's readiness for the recovery. But what about the broader ecosystem?
Yet consider this. If millions of U.S. homes are sitting aging right now, building up a massive backlog of delayed renovations, what happens to the broader global supply chain when that dam finally breaks?
Oh, man.
Right. If a 5-year backlog of remodeling projects kicks off in a single 18-month window once rates drop, Floor & Decor might have the physical store space to handle the customers.
But will there be enough materials?
Exactly.
Yeah.
Will there be enough raw timber, ceramic, and shipping containers in the world to meet a simultaneous market-wide surge in demand? They might survive the freeze, only to find the thaw brings an entirely new kind of supply chain chaos.
A completely fascinating dynamic to watch for anyone tracking the broader housing materials sector. Thank you for joining us on this deep dive into the hidden mechanics of Floor & Decor. Risk defined, portfolio protected.